In the world of crypto, few stories have risen and crashed as hard and fast as the one involving Sam Bankman-Fried and FTX. It's a tale of ambition, billions, and one of the most shocking collapses in financial history. So let's rewind and break it down, step by step. It all started in 2017 when a young MIT graduate named Sam Bankman-Fried, SBF for short, launched a trading firm called Alameda Research. The idea? Use complicated strategies like arbitrage to profit off price differences between global crypto exchanges. And it worked really well. Sam became known as the math genius in cargo shorts and messy hair. In 2019, he launched FTX, a crypto exchange built by traders for traders. The platform grew insanely fast. It was clean, intuitive, and offered innovative products like tokenized stocks and leveraged tokens. Investors loved it, users trusted it, and Sam became a celebrity. He was everywhere: interviews, magazine covers, Capitol Hill, you name it. By 2021, FTX was one of the biggest crypto exchanges in the world. Sam's personal net worth ballooned to over $20 billion. He promised ethical leadership, ran Super Bowl ads with celebrities like Tom Brady, and bailed out other struggling crypto firms. People started calling him the White Knight of crypto. Meanwhile, he was living in a $40 million penthouse in the Bahamas with a bunch of colleagues/roommates. No red flags there, right? But behind the scenes, trouble was brewing. Alameda, his trading firm, was making big bets, sometimes risky, sometimes reckless. And reportedly, it was being secretly propped up by customer funds from FTX. That's right. The money people deposited into FTX for safe trading was allegedly being funneled into Alameda to cover losses and make even riskier bets. Fast forward to November 2022. A report from CoinDesk leaked a copy of Alameda's balance sheet. It showed that a huge chunk of its assets were FTT, the token issued by FTX itself. In other words, the empire was built on its own brand, and not much else. Then came the knockout punch. Binance, FTX's biggest competitor, announced they were selling off their FTT holdings. Panic hit the market. People rushed to withdraw funds from FTX. The exchange couldn't keep up. Billions vanished in days. FTX froze withdrawals. The house of cards collapsed. On November 11, 2022, FTX filed for bankruptcy. Over $8 billion in customer funds were missing. Sam resigned as CEO. Investors were stunned. Regulators pounced. Crypto prices tanked. And suddenly, the man once hailed as crypto's savior was being investigated for fraud. In December 2022, Sam was arrested in the Bahamas and later extradited to the US. He faced multiple charges, including wire fraud, securities fraud, and money laundering. His trial was one of the most watched financial cases in years. Former friends and colleagues testified against him. Screenshots, spreadsheets, and Slack messages were all part of the evidence. It was like watching The Big Short, but with crypto memes. Eventually, in 2023, Sam was found guilty on several counts. The fall was complete. From genius billionaire to convicted felon in less than a year. The FTX collapse sent shockwaves through the crypto world. It exposed major weaknesses in oversight, transparency, and trust. Regulators started tightening the screws. Retail investors became more cautious. And the era of trust me bro finance began to die out. Sam Bankman-Fried's story is a lesson in what happens when hype, power, and zero accountability mix in the world of high finance. It's not just a crypto story, it's a human one, and it's still unfolding.